Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at iCM, and today I'm excited to be joined by Jarad Vazquez from the Allspring Core Fixed Income team. Jarad, thanks for joining us.
Thanks for having me.
Awesome. So let's jump right in. As I'm sure you're aware, 2024 has really been kind of an interesting environment from both a Federal Reserve and interest rate standpoint. And recently, we've seen a really pretty meaningful uptick in rates and a corresponding decrease in near-term rate cut expectations. How have you guys at the Allspring Core Fixed Income team digesting this at the moment? And do you really think the market has finally gotten it right, as they appear to be a little more dovish than the Fed earlier in the year?
Yeah, I think it's been a really interesting year, right? And it's really gone back further than that. You know, you think back to where we were a year ago in 2023, and you really have volatility pick up, as expectations of what the Fed were going to do towards the end of last year were starting to change. As they stopped, the real focus became on, okay, how long are they going to stay stopped? When are they going to start to cut? And I think eventually, the volatility will be driven by where are they going to cut to? And,
Sure.
we're kind of in the middle of all that now, right? So we've had them start cutting. I think you've seen the market really get ahead of itself a few times over the last couple of years and really trying to stay a step ahead of where the Fed is. I think we saw that with a 50 basis point cut as well. We were pricing in 5-6 cuts post that meeting, and they were pretty clear. And I feel that their transparency has gotten better and better. When they came out and told you that it was 100 by the end of the year, including now 50, they kind of told you it was 25-25, right? And it could have been a 50 blank or a blank 50, but it felt like 25-25. I think the data that we've seen since that meeting has gotten the market a little bit more comfortable with what they had said and what they projected. And, right now we're kind of pricing in, 1 to 2 more cuts, closer to 2, but before the end of the year. And I think that's in line with what the Fed has been talking about, or what they've been telling you that they want to do. That's their game plan. I think when you look at the economy and the jobs picture, we're still in a very healthy place. The last CPI print, probably a little stickier than people were expecting to see. And I think that just gives the Fed a lot of room to think about what they're going to do. They can go at a measured pace. And at some point, they can pause and see where we're at. And I think that's where we're at right now. We're trying to figure out, okay, when does that point come, right? And that's what's going to drive some of that volatility going forward. But I think right now, with where rates are currently priced, I think the market has a pretty good feel for the data and what the Fed's been telling you. And I like where we're at right now.
Sounds good. Great information. Can you give us a little more insight into how your team is currently managing the core bond strategy in this environment? And, where do you see the greatest risks and opportunities?
Yeah, I think, it's been a great year for active security selection driven type managers. You've had what I would consider a more normalized level of volatility over the last year and a half. And granted, it seems like a higher level of volatility given what we had seen before. But I think the Fed keeping rates at 0 and keeping vol suppressed was the more abnormal market. Where we're at now, with yield levels where they are, with the volatility we're seeing in spreads, the overall spread levels, I think you're in a more normal market environment. And this is something we can expect to see going forward. As far as our team and how we're managing risks in the market right now, we've been keeping, overweights closer to home. We've been really focusing on the security selection opportunities within the sectors on high-grade fixed income. Okay. So, when you think about where spread levels are across the sectors that we focus on, IG credit, agency mortgages, high-quality structured products, you have spreads that have started to move back in. And, in the case of credit, you're right around all-time tights. That doesn't mean there's not things to do there, though. It might mean that it's a little tougher to drive excess alpha with a big sector overweight and a carry profile with spreads at the levels they're at in that space. But there's a lot of dislocation within the sectors underneath. Agency mortgages, another sector that we play pretty big in, and it's a real strength of our team. That sector, since the Fed really stepped away in 2022 with outright buying, has really kind of created those dislocations again. The volatility that we're seeing in the rate market, as well as the expansion of the coupon universe there, has really opened that up as a very fertile opportunity set for security selection. I think back to 2018 or 19, and you had 3 or 4 coupons that made up almost 90% of the index.
Sure.
We have 10 or 11 tradable coupons now. You have the CMO machine working there again. Hybrid arms are being produced again. There's a lot of things in that market right now that you can look at and exploit relative value in. I think that's one of the probably richer opportunity sets from a dislocation standpoint. High quality ABS is another space we play in. And that's a sector when I look at, I think is still looking fundamentally cheap relative to where some of the other spread sectors are trading. And it's an area where there's a good new issue market, there's good liquidity, and you can really take advantage of some of the fundamentals that you can get through research to take advantage of dislocations in that market right now.
So you mentioned ABS, or asset-backed securities. This is a pretty unique area of the market that many investors, especially those in simple, just indexed ETFs, are likely underweight. Can you give us some insight into your team's specialization there, and maybe just touch on where you're finding value today?
Yeah, I think the ABS market, or asset-backed securities market, is a unique market, relative to high-grade fixed income. It's got a little bit of credit in it, but it's got a little bit of structure in it as well. You would see in the CMO market and mortgages. And I think when you really dig into that market, there's a lot of opportunity to differentiate between names. For our team, we play in the highest quality parts of that market. We play in the AAA part of that market, which is the most liquid part.
Sure.
Really focused on high quality automotive ABS, credit cards, student loans are in that space. We would also look at non-qualified mortgages and some of the structures off of those deals in that space, as we think it's a comparative, type of value and liquidity. And when we look at that space, we really think about it in terms of like kind of liquidity buckets. It's all AAA, it's all very high quality, but you have a lot of different kinds of assets underlying these bonds, and you have different buyer bases that are playing them, frankly. The new issue market is different, and you're seeing more new issue come in certain parts of that market than others. And that can really kind of drive some distortions. I think coming into 2024, we were probably a little more focused on the second tier liquidity portions of that market. So that would be private student loans, rental car ABS, and maybe some of those non-qualified mortgage bonds I talked about.
Sure.
As we had a tremendous amount of new issues, especially earlier in the year in the automotive part of that space, you really saw that part of the market kind of lag the tightening that we saw in credit. Now, although they've tightened and performed very well, you still have spreads that are 40 to 60 over, in a market where at the beginning of 2022, a lot of these things were trading single digit to teens type spreads. So while they have tightened and come off of the wides, we still think there's some fundamental cheapness overall in that sector relative to short parts of the credit market and parts of the agency mortgage market. And that's really allowed us to kind of move the pieces within that sector and take advantage of some of the dislocations and compression trades that we've seen throughout the year so far.
Awesome. Jarad, great information. I want to thank you for joining us today. A huge thank you to our guest, Jarad Vazquez from Allspring, core fixed income team. Should you have additional questions, please do reach out to our team here at ICM at 888-426-4689 or via email at info@icm-invest.com. Thank you for taking time out of your day to watch this video. And Jarad, thanks for joining us.
Thanks for having me.